So as usual, we start off just with a little disclaimer. So trading involves the risk of loss of capital, not suitable for everyone. And of course, if there's leverage involved, you can lose substantially more than that initial investment. The views, opinions, all the information that's continued in these YouTubes and other content that we put together is purely for educational purposes. We are not trying to encourage you to trade or invest. That has to be your decision. And of course, you should carefully consider the risks, your financial situation, level of experience, definitely your risk appetite as well. And of course, you should only risk capital you're prepared, but more importantly, that you can afford to lose. If you have any doubts whatsoever, seek independent financial advice before risking your capital. Very important, that bit. Okay, so let's move on to what happened last week. There wasn't that much data out last week, but there was still a lot going on. So German factory orders were lower, month on month, that is. And also the EU retail sales were down 2% year on year. In the US, data went weaker than stronger. So, if we look generally at the data, I mean, it gave investors hope at the start of the week in the US. However, come Friday, that was destroyed. NFP data probably would have caught a lot of traders out. Their instinct is to, when the data's good, that they expect the market to go up. But that's just not the case with the current macro picture. Generally at the moment, again, when central banks are involved, it all goes a little bit skewed. And that therefore sort of, the good data means that the central banks are going to keep being more aggressive with their stance on rates, where they are trying to counter inflation, or at least the consumer driven part of inflation. So manufacturing slipped as well. PMIs were okay. Jolts now, Jolts came in and with that, sort of the job openings dropped, and ADP was strong at 208,000. ISM was strong, so it was a beat at 56.7. So it's all a bit sort of jumbled up at the moment, and that's sort of what sort of caught investors out last week, I would say. The early part of the week, they was expecting the Fed to cut back a little bit because the data wasn't strong enough. But then towards the end of the week, when it came to jobs data and such like, then the strength came back. And as I was saying, when that strong data comes out, you've got to expect the central banks to be more aggressive with hiking rates, where they're trying to get control back over inflation again. And of course, last week there was plenty of central bankers providing their insight. And again, some mixed views there on how aggressive they should be or backing off even. And Australia raised rates to 2.6%. That was only a 25 basis point hike, and there was quite a few that expected 50. However, New Zealand did increase by 50 basis points, and their rates now are at 3.5% already. And then, of course, we had OPEC plus that cut production by 2 million barrels a day. US dollar dipped early week because of the data, and then recovered strong on Friday, again with those expectations of rate hikes. Stocks were up and then crashed on Friday. Oil strong, just purely on fundamentals. So when we look at the sort of key data that's coming out this week, first of all, just keep an eye out for corporate earnings if you're dealing anything, you're trading anything stock related. It's the end of the third quarter, so we've got to expect all of the performance so far to be posted. So just be ready for some of that, especially the big companies, because they're the ones that are really going to sort of impact the stocks and the indices, of course. In the US, got lots of data out, PPI, CPI, inflation data. So that is going to be really, really relevant again to what goes on with the Fed soon. Also, Monday is a holiday. Just to highlight that, just so you're aware of that. Michigan consumer sentiment, retail sales, and of course on Wednesday we've got the FOMC minutes as well from the last meeting, so that'll be watched with keen interest. And then we've got the WASDE report, commodity report, that is coming out. In case you don't know what that is, that's the World Agricultural Supply Demand Estimate. So it gives you a good insight into what expectations are going forward for the demand for commodities. And of course, just got to look at that supply and demand for sure. Then when we move on to the UK, unemployment and earnings. So again, they're going to be important for the pound this week. GDP for August. Again, keeping an eye on that. You know, remember GDP is like that full health check of an economy. It's goods and services, industrial production, manufacturing, and again, you know, they're going to be important to see how we're doing. You know, to be honest, I'm in the UK. I walk around the shops. Everyone's full of shoppers. You know, people are buying. They've got carrying bags with them. Supermarkets still full. So, you know, don't get fooled. You know, there's a lot of negative information and data coming out about the UK. And sure, you know, we're heading for a recession, the same as pretty much everywhere else eventually. But economically at the moment, or consumer-wise, you know, the demand is still there. In the EU, not so much coming out. We've got industrial production, and then Germany, France, and Spain. We've got CPI. Again, just remember PPI, CPI, inflationary data. Very, very good to look at. And in China, they've got their CPI out as well. You know, where everyone else is sort of going in for tightening, China's not in that area at the moment. They're still adding stimulus. And of course, they've got problems with real estate at the moment. So, macro outlook. So when we look at inflation, it's still sticky in the EU. It's just hit 10%. So, you know, we're not seeing that drop down at the moment. Now, part of that for me is caused because, well, you know, I would expect PPI to be dropping just purely because raw material prices have been coming down, making that little bit cheaper for producers. However, we're not seeing that reflected in CPI as companies keep the cost savings for themselves. You know, their profit margins are above 15%, which is the highest it's been for decades. Now, stagflation, you know, this inflation without growth is already impacting some countries. And of course, over time, that is going to go from stagflation into full-blown recession. And, you know, there's going to be many countries that just go straight into recession as well. When it comes to supply chain issues, you know, there's a variety of those still around. We've still got OPEC. I mean, obviously, as I've mentioned, they was cutting. They decided to cut by 2 million barrels a day. Now, you know, that in itself is not, you know, it sounds a lot, and it is. But the problem is that they've got a quota system. You know, they're allowed to produce or export so many barrels per day. And I don't believe that they've been able to even fulfill those quotas. They haven't been able to produce enough. So, again, for me, that means that, okay, they're 2 million barrels off the market, but it's not really 2 million barrels because they weren't producing that full amount anyway. And of course, you know, now there's going to be potentially EU and possibly other countries coming out with further sanctions against Russia. Now, Putin could, if he had a mind to, really cut the oil supply down. So he could go from just sort of achieving or meeting his quota to actually dropping his supply substantially more, similar to what he did with the gas, or what he's doing with the gas rather, and only export to his friends. And again, you know, he hasn't got so many of them these days. So, you know, he's got some like big ones like India and China that have got massive populations, obviously. So the demand is there for sure, especially as he discounts it. But you know, again, we just got to watch that, because we saw what happened to the price of gas. Is the potential there for that to happen to the price of oil as well? You know, I mean, it's possible that they could counteract that a little bit, but it would take America to lift sanctions and controls off of Venezuela and or Iran for that to happen. Okay, so also we've sort of still got China with some lockdowns, and as I mentioned earlier, that they still have a real estate crisis that's ongoing. So I'm not sure what's going to happen there. And of course, you know, Ukraine is fighting back still. They're making progress. They blew up the bridge to Crimea from Russia, which again is embarrassing for Putin. Energy prices moved up on all of that. And, you know, with European temperatures dropping, big question is, are they going to have enough over the winter? So, you know, it's difficult. You know, we've still got we've definitely got energy inflation. We've still got some food inflation, but as I say, it's not quite as high as it was. But again, we've just got to keep an eye on the weather fronts. There's still that lack of workers going around, which is keeping that earning pressure up. And that's probably sort of part of why companies aren't passing on any savings at the moment. So this is quite interesting. This is from ING. When you look at the macro outlook, so I'm just going to let you sort of absorb what it tells you. So look at the key at the bottom first, so that you understand it. It's just relative importance, so 1 to 3. And it just looks at energy prices, political, government, central bank, financial, and COVID. But I thought that was a really interesting chart. So just talking a little bit, just to give you time just to absorb that. And of course, you know, you can always pause it while you do study it. It's definitely worth taking note of. And of course, the countries: US, Eurozone, UK, and China. Okay, moving on to the tip of the week. It's a macro tip, and you know it sort of comes back to what I was talking about earlier with the data. You know, when central banks are extremely active in the economy, effectively in the markets, then macroeconomics can become skewed. You know, when they're doing quantitative easing, which they were up until the end of last year, you know, good and bad data takes the markets higher. Good data takes it up naturally, obviously, because it's positive. Bad data would as well, because you know the central banks are going to come in and be more aggressive when they're adding that stimulus and asset purchases. Of course, now we're going through the opposite. We're going through the quantitative tightening. And, you know, the current situation at the moment is, you know, good data will send the markets lower. And the reason for that, as we saw Friday, is, you know, for investors, traders, we know, especially at a professional level, that the expectations of a more aggressive approach by central banks with rate hikes. And they're not going to stop anytime soon. And not only that, when those interest rates are raised, don't expect them to come down quickly. They're not going to. Remember, this is just my personal view, but trust me, I really don't believe I'm wrong here. I've been saying this for some time. So again, just a little macro tip there. It's micro as well when it comes to the data. But you know, just think about the situation, and you've really got to sort of understand or feel what the Fed's going to do, or whatever central bank, depending on, you know, where you're trading, the countries that you're looking at, for example. You know, from my mind, what they're really trying to do is drive the economies into recession, so they can do a complete economic reset, because that should drive inflation down eventually. But as I say, don't expect them to just turn that policy around very quickly. They're not going to. They're going to want to see 3-6 months at least, I reckon, of sort of that sticky 2% inflation or around there, before they feel confident enough that they can start to reduce rates again. And, you know, trust me, for the moment, that all that free money, all that cheap money has gone. Don't expect that to come back quickly at all, not in the foreseeable future. Okay, so now we're going to move on to the second part, which is some technical analysis. You know, with stocks, investors return to the market at the beginning of the week up until midweek, and then, you know, Friday just sent the stock market well down again. It was real quick action. Gold finished the week higher, but again, it was been following stocks. WTI had a strong week just because of the fundamentals around that, you know, cuts in supply and the danger of Russia cutting even more. Dollar started the week weak because the data was weak, but again, as that data sort of strengthened towards the end of the week, so did the dollar. And, you know, again, it all comes back to these expectations of what the Fed's going to do. Okay, so just a little bit of a reminder of, you know, the colours, etc., that I've added to the chart. So black, they're trend lines effectively, so support resistance levels. So in the right hand column, when you see them in the right hand axis, that's what they are. The brown numbers are breakout levels, so if it can get through that, I'm expecting it to continue to go. Claret numbers, they're just horizontal levels based on 2 or 3 tops or bottoms, or where I can see some congestion rather, and I believe that, you know, there is a support or resistance level around there. Whether it's going to hold or not is another matter. And blue numbers are just indicating the last traded price. And of course Fibonacci, there isn't any Fibonacci this week, but it's there, so you know, just remember it for future weeks. So Dow Jones, when we look at that, so on a daily I can see resistance, you know, quite a bit above the market at the moment at 31,292 and also at 30,509, and support at 28,277. You know, just keep in mind of these levels, and you know, obviously, you know, you can put them on your charts, or you can add your own as well as you go through the day and the week. You know, all we're trying to do is prepare you for the week ahead to give you more time to focus on your trading, and hopefully, you know, we provide you some good levels. And newsletter certainly does on a daily basis, so you should really sort of sign up for that if you. Okay, so on the 30-minute, you know, as you can see, after the NFP data came in, stocks went into free fall, and now I've got resistance at 30,114 and 29,924, with support at 29,141. So we're going to move on to the S&P. You know, sort of a fairly similar picture on most of them. Again, just starting with the daily. So here we're looking, and I've got resistance at 39.62, 38.19, and 37.42. That's where, in my mind, support has become resistance, that last one, so the lowest one. So just keep an eye on that one. And then I've got support at 35.18. I haven't put any pivot points on this week because I just didn't think I needed them, and I just wanted to leave the chart really clear for you to be able to see what's been going on. So here's the 30-minute, and I've got higher resistance at 37.70, 37.34, then down at 36.66, and support at 36.25. Moving on to Nasdaq, resistance at 11.742 and support at 10.671. Again, you can see Nasdaq, the way it reacted to that non-farm payroll data and the earnings, and the unemployment number dropped back down as well. It was 3.5, went up to 3.7, back down to 3.5 again. So strong data. And so when we look at the 30-minute on the Nasdaq, we've got resistance at 11.544 and 11.133 with support at 11.022. So the Russell, which is those small and mid-cap stocks, on the daily, we've got resistance at 17.82 and support at 16.15. On the 30-minute, it's at 17.70 and support at 16.95. They're wide prices, obviously. So as Monday gets going, just remember, Columbus Day on Monday in the US. So don't expect too much. That doesn't mean volatility won't be there, but maybe a lot of traders going to have a long weekend. We'll have to wait and see. But, just sort of add new lines if you're doing your own analysis to go with these as and when. Now moving on to the currencies. So the pound steadied, although it's still vulnerable, and it's all still quite relative to what's going on with the USD, because that is still the king of currencies. Keep an eye on what's going on politically in the UK as well. So when we look at the daily, I've got resistance at 115.10 and I've got support at 101.88. I know they're massively wide, but there are some big swings around in FX at the moment. Usually it's the least volatile of all the asset classes, but that's not necessarily the case at the moment. They're all volatile. That, in fact, if anything, crypto's possibly least in comparison. Okay, so moving on to pound against the dollar, also called cable. And on the 30-minute, we've got resistance at 113.82, 112.54, and also 111.73, and support at 110.66. The euro against the dollar on the daily, resistance is just above $1, so it's at 1.0037 with support at 0.9532. So that's on the daily, and then the 30 minutes to that, I've got resistance at 0.9895, 98.31, and 0.9825. So a little batch of them pretty close together, and then support at 0.9781. Moving on to Bitcoin, as I say, that was ranging for most of the week. It seems relatively stable in comparison to the other asset classes at the moment. So I keep that brown breakout line on there, and that's, it is well above the market, but suddenly these markets can liven up either way. So I've got 27,370 as the breakout there. Below that as resistance, I've got 20,427 and support at 19,147 and 18,110. As you can see, each of those candles are dailies, and they've just sort of really just shrunk down in size. And then when we move across to the 30-minute, I've got resistance at 20,090 and also at 19,540, and I've got support at 19,220. And of course, I always like to add this one in because last week it sort of broke a little bit, this correlation, but it seems to be back again at the moment. As I say, just be careful because the stocks seem to be moving much faster than actual, I can't believe I'm saying it, than Bitcoin. And of course, that correlation strengthened a little bit the past week. However, I do expect stocks to remain volatile based on Fed expectations. So moving along to gold. Now gold just sort of, again, it seems to be doing its own thing. It's almost tracking stocks at the moment rather than having that more traditional inverse relationship, when we look at these risk on, risk off scenarios. On gold, we've got resistance at 1762 and also at 1723, with support at 1652 and 1597. And then when we look at the 30 minutes, I've got resistance at 1721 and 1717 there, and support quite close to where it closed at 1700, and then 1693. But 1693 again is a brown because it's a breakout. If it breaks there, there's potential for it to go lower. So last but definitely not least is oil, WTI. So, as I mentioned a couple of weeks ago, and again back last week, below 80 was where I expected the US to come in to start to replace their strategic reserves. This is oil that they hold back in case they need it because there's supply chain issues anywhere, and they can't get hold of it. Oil is being very fundamentally driven at the moment, but it is also geopolitically driven. Yes, OPEC cut by 2 million barrels a day, but I think the overriding factor that is on traders' minds at the moment is that, when the EU add further sanctions, that Putin, Russia, could retaliate by a cut in supply, in the hope that it has the same impact as it did on the gas. So, that's really sort of looking for, I would say it's looking for, he's trying to punish Europe economically, where he's trying not to do that with military at the moment, which is probably good for him because he doesn't seem to be doing so well in Ukraine. And let's wait and see what happens there. But, it is still a bit of a lopsided picture. So anyway, let's move on to the 30-minute, which is the chart. And there, I'm not sure I gave you the levels that talking about it fundamentally. So on the daily, it's 99.21 resistance and 98.20, with support at 77.03. So sorry about that. On the 30-minute, I've got resistance at 93.31, so very close to where it closed. And then I've got support at 92.10, 92.05, and then way down at 87.97. So that's sort of pretty much it in the way of the analysis week and the macro. We can really help you with your trading, whatever level you're at, and we'd love to be able to do that and provide you with more information. This is just a small part of what we do to try and help people, when it comes to trading. So, our look back at last week, our look forward, our macro outlook, your trading tip, and of course, all of this analysis. It's just to try and help prepare you for the week ahead. So, you know, if you like it, then please tell friends and other traders, put it in your chat groups. Let's get more and more people involved in this, because we'd like to help as many people as possible. And of course, we've got our daily newsletter, which includes all the global news across all the different asset classes. And not only that, but it has all of these fresh chart levels each day and fresh pivot points each day as well. And there's the sign up for that. And then we do 1-day workshops, which are topic specific, just to help you fill in any gaps you have in your trading. We even do one which is trading for beginners, to help people get started, or at least work out if trading could be their next career. Course-wise, we do 1-week intensive courses, and we provide them to individuals as well as companies, exchanges, various other people come along on those courses, just to sort of get a real deep understanding of what goes on within the markets, and of course a trader's perspective as well. And then we've got our full-on master classes, where, you know, we give such a deep dive into all of the macro and as well add the trading skills. So again, reach out to us. We're happy to discuss any of these with you, and also to help you, you know, work out which course is right for you. And then we do trader mentoring, consulting, so we consult to companies as well as individuals. You know, we help with hedging strategies, and of course we're a provider of educational content to exchanges and brokers. You know, if it's anything to do with trading, we're pretty much all over it. We've got our own prop trading desk, and of course anyone that goes through our master classes can impress, pass the exam, pass the challenge. We're happy to actually offer them a job trading for us using our capital. Now, contact details, if you want to contact us generally, it's info@symaxfintech.com, or if you would like to contact me personally, ask me anything about trading, then it's chris.tubby@symax-int.com. If you are interested in going into other areas of finance, and you know you need to prepare yourself and go and sort of build up your knowledge and all that, we have a whole mass of other areas covered now, with 85 other educators and hundreds of different courses. We service over 1,000 companies per year and over 10,000 students. We're one of the leading ones in the whole of Europe. So again, you can reach out to me and I'll give you a lot more information on that. All it leaves me to say is thank you very much for watching and listening, and I look forward to seeing you next week, and have a great week.